$1,022 profit in a single trading day, actually in a single session on a Monday morning in late July. 2 contracts on a SOXL call option, opened and closed the same day. No overnight risk, no sweating through earnings. Just a clean read on semiconductor momentum and the discipline to close when the trade handed you the money. The question is, was this luck, or was there a real setup here? Let's get into the actual numbers. The strike price was $85, deep in the money relative to SOXL, trading in the low 120s. The call was opened at a premium of $45 per share. Each contract covers 100 shares, so 2 contracts cost $9,000 total. That's your capital at risk. The expiration was September 4th, 2026, giving about 5 weeks of time value on top of the intrinsic value. Your break-even on the underlying is effectively $85 plus $45, call it $130 at expiration, though intraday, you're just looking for the premium to expand as SOXL moves, and that's exactly what happened. The option was closed the same day at $50.11 per share, a gain of $5.11 per share, times 200 shares across 2 contracts. That's $1,022 in one session. Return on capital at risk, just over 11% in a single day. On the price chart, SOXL opened July 27th around $121.50, already showing gap-up energy from the prior week's chip rally. The stock climbed steadily through the morning session, touching an intraday high near $126.80. A mole closed the position with SOXL around $125.90, not the absolute top, but well off the lows. The current price sits at $128.15, meaning the stock has continued grinding higher even after the exit. The chart tells a clean story: gap up, trend up, no major intraday reversal to navigate. After the exit, at roughly $125.90, SOXL kept climbing. The current price is $128.15, meaning the stock moved another $2+ after the close. If you held the position to today, the additional gain would have been meaningful. So yes, there was money left on the table. But here's the honest read. At the time of exit, there was no way to know that. The stock was up strong, the trade had hit a clean profit target, and same-day trades are not designed to be held. The exit timing was disciplined, not perfect. Here's the real takeaway from this trade. And it's not about SOXL specifically. It's about the relationship between leverage and time. SOXL is already 3 times leveraged. When you buy a call option on top of that, you are stacking leverage on leverage. That cuts both ways. It's why you can make $1,022 in a single session. And it's also why you can watch your entire $9,000 evaporate if the sector reverses hard. The trade worked because the directional read was correct and the exit was taken. But ask yourself, what would have happened if SOXL had opened down 4% instead of up? Same capital, same structure, but now you're watching a deep in the money call lose intrinsic value fast. The lesson is this: when you use deep in the money calls on leveraged ETFs, you are not reducing risk through option structure. You are simply taking leveraged directional exposure with a defined maximum loss. Know that going in. Have a price level where you close the trade if it goes against you, before you ever hit the buy button. This trade had no overnight risk, which was smart. The one thing you can do with same-day trades on instruments this volatile is not give them a chance to hurt you while you sleep. That's the sensible trade for this week. If you want every trade broken down like this, the entry, the exit, the lesson, and the numbers, head to thesensibletrader.com and subscribe. Follow us on Twitter at @thesensibletrade for daily trade breakdowns and market insights. Every trade teaches you something. The goal is to keep learning and keep trading sensibly.